Hi everybody, my name is David McKeegan. I'm with Greenback Expat Tax Services, and on the line today I've got Norman Viss from Expat Everyday Support Center, and we're going to run a little bit of a Q&A about US expat taxes today. So to kick us off, again, my name is David McKeegan. I'm the co-founder of Greenback, and I've got Norman on the line. He's an expat life coach at Expat Everyday Support Center. We've also got Daria, who is one of our CPAs on the call, and she'll be available at the end to help answer any questions that people have. Now, to ask a question or make a comment, if you're dialing in on your computer, you can just do that in the chat box, or if you want to wait till the end, we'll actually do a Q&A section on the end too, where people will be able to type in their comments, or we can unmute everybody and have people ask questions directly as well. If you have questions that are more sensitive, so things you don't want everybody else on this call to see or hear, then please email them into us at info@greenbacktaxservices.com. And you can just put in the title webinar, and then we'll prioritize responding to those questions. I'll tell you a little bit about Greenback, and then I'll ask Norman to tell you a little bit about Expat Everyday Support Center. My wife and I founded Greenback back in 2008. We've been living abroad since 2002. And for a long time, one of our big pain points was around expat taxes, and Greenback was sort of our way to really try and resolve that for ourselves and for our fellow expats. All of our U.S. accountants are either U.S. CPAs or IRS enrolled agents. We're not outsourcing this work to data rooms in India or China or any of that kind of stuff. People work directly with the accountant to prepare their tax returns, and our entire team works virtually, and we're really spread all across the United States and around the world. We specialize in helping U.S. citizens who are living abroad become and stay compliant with their U.S. expat taxes, but we also now offer individuals living in Australia, Canada, and the UK country-specific tax services, so Australian tax services, Canadian tax services, and UK tax services. Norman, do you want to just jump in and tell us a little bit about Expat Everyday Support Center?
Yes, thank you, David. It's great to be on a webinar with you again. We did one together about 2.5 years ago or so, which was a lot of fun, so it's great to be doing it again.
Yeah,
my name is Norman Viss. I've been an expat actually since 1977 for quite a while. I've sunk my roots deep into 2 areas of the world. One is West Africa, where I spent 10 years, and then 22 years in the Netherlands. And I'm now living back in Philadelphia. Together with my coaching partner, I run Expat Everyday Support Center, and we provide online coaching support for expats around the world. Just to give you a little example of something that we do, a few weeks ago I had a 15-minute coaching session with a lady who was struggling with road rage in Kenya. As you can imagine, it was just a real problem for her. And we chatted with her for a while and finally came up with the solution that she had a little piggy bank in her car, and every time she felt road rage, she'd contribute, I don't know, some coins into that piggy bank, and then contribute that money when it got to be a certain amount to an anti-corruption campaign that was going on in the country. So trying to turn what was a negative thing for her into a positive. That's the kind of thing we do, and we love doing it very, very much. So that's just a little bit about me, David.
Great, thank you for that. I have never been to Kenya, but I imagine the traffic probably would drive you crazy from what I've heard. Well, why don't we dive into the tax stuff?
Yeah. The idea is that I'm going to ask you some of the questions that have come in from listeners over the last couple of weeks, or that in general are important questions, especially for U.S. Citizens to know about taxes. This is an issue that's near and dear to my heart because about 5 years ago I received out of the blue a letter from the IRS saying they had put a lien on my United States savings accounts because of tax issues. And so I had to scramble a lot to get that all repaired. So I'm right in with this topic and just want to underline the importance of it for everybody, not to ignore the IRS because they will find you. Shall I go ahead with the first question, David?
Sure, that'd be great.
Okay, here I go. The question is, do I need to file a separate FBAR if I'm on a joint account with a U.S. spouse? And you probably should also explain to us what an FBAR is.
Sure. Let me just jump over to that slide. I think you and I are on have a different order here, but that's not a problem.
Oh, I'm sorry. I am sorry. Yes, I did skip one. We'll go back to number 4, but we're on number 5 now.
Yep. Okay, so the FBAR, which has actually been renamed Form 114A, is basically the foreign bank account report, and this is the form that anybody who has over $10,000 in all of their foreign financial accounts at any point during the year needs to complete and send to the U.S. Treasury by June 30th. So this is not an IRS form, this is a U.S. Treasury form, and it's basically asking you about all of the foreign bank brokerage, all those kinds of accounts that you have outside the United States or that you have signing authority on. So, maybe it's a business account for your employer, but you have signing authority on that checking account. So you would then need to report that account on your foreign bank account report.
Okay,
now,
great.
As far as, do you need to file a separate FBAR if it's a joint account with your spouse? The answer is maybe. So if your spouse is filing the FBAR for a joint account, you don't need to file a separate FBAR if the following conditions are met. So if all the financial accounts that the non-filing spouse is required to report are jointly owned with the filing spouse, the filing spouse reports the jointly owned accounts on a timely filed FBAR, and both the spouse and the filer have completed and signed Form 114A, the record of authorization to electronically file the FBAR. So you don't need to file separately if you're meeting all of those requirements. But if you have some accounts that are joint and some accounts that are separate, then you're going to need to file separate FBARs. There's no way to just file one FBAR for two people reporting some accounts that are individually owned and some accounts that are jointly owned.
Right. Got you on that. Let me go back to the question we should have started with, and that's this one. If you depend fully on a foreign spouse's income, do you still need to file federal tax forms? And I'm assuming you mean there, let's say that I'm an accompanying wife and I'm not working, my husband's working, I have no income at all. So the question is, do I still need to file federal tax forms?
The answer here is pretty simple. It's no. So if you don't earn the minimum amount required to file, then you don't need to file a U.S. tax return. But what we will note here is that even if you're not required to file a U.S. tax return, you may still be required to file the FBAR. And again, the FBAR is the Foreign Bank Account Report. It's the U.S. Treasury form, and this is required if you have over $10,000 in all your foreign financial accounts, so your checking accounts, savings accounts, stocks, bonds, all that kind of stuff. So if you're over that $10,000 threshold, you'll still have to file the FBAR. But if you don't have any income or your income is under the minimum required to file a U.S. tax return, then you don't need to file the U.S. tax return.
Right.
And the last bit I'll note on here is you don't need to file the FATCA form, so Form 8938, if you're not required to file a U.S. tax return. So again, if you're and we'll get into FATCA a little bit more later in the presentation, but if you're a spouse, you're not working, and your spouse is the main breadwinner, then you might not need to file anything, including an FBAR, unless you have over the $10,000 in the foreign financial accounts that you are a signatory on. That make sense?
Well, sort of. I mean, and I hope everybody probably has figured out by now, I'm not an accountant, so a lot of this is abracadabra to me in the sense that I'm just not at home in this world. So the question I'm going to ask right now is maybe more of a coach's question than an accountant's question, but why does the U.S. government want to know what I have saved in foreign bank accounts? Is it because they want to tax it, or is it because they want to make sure I'm doing nothing nefarious?
To be honest, it's probably a little bit of both. A lot of these forms, the FBAR has been around for a while. A lot of the FATCA forms came into play because people were hiding money in Swiss bank accounts and keeping assets offshore out of the reach of the tax man, not reporting them. And some of the people doing that are normal everyday people. Some of them are drug dealers or terrorists or people trying to fund terrorism. And basically what the IRS has been able to do, or the U.S. government's been able to do through FATCA, is really just strong arm all of the other governments in the world and all the financial institutions in the world in order to give the U.S. government access to all of this information.
Right.
And it's scary. Like, I've spoken to people who tell me that they file their FBAR every year, and immediately upon filing it, they close those accounts and open new accounts so that they have new account numbers, because they don't trust the U.S. government to keep their account details safe.
Right. Yeah.
If you're a hacker trying to gain access to people's bank accounts, trying to hack into the U.S. Treasury where they have every single account number for every account owned by a U.S. person anywhere in the world might be a good place to go.
Yeah. Okay. There's a whole lot of rabbit trails we could go on down there, but we need to stick just a little bit to the topic, or we'll be here all day. So there's all kinds of bait hanging there, but I'll just let it go and move on to the next question, which is on slide 6 for the person doing the slides. If I live abroad, am I automatically eligible to use the foreign earned income exclusion? And I'll just say, the layperson's, what I understand by that is, if you make up to a certain amount, any amount you make up to a certain amount of money is not taxed. If you make it in the foreign country and there's certain qualifications you meet, then the U.S. can't tax you on that, so that you don't get taxed twice. So are you automatically eligible for that if you live abroad?
The answer is no. It's not that you're automatically eligible. You need to meet a couple criteria in order to receive the foreign earned income exclusion. And as you mentioned, the foreign earned income exclusion allows you to exclude a pretty big chunk of your foreign earned income from U.S. taxes. So for the 2014 tax year, it's $99,200, and this is going up to $100,800 for the 2015 tax year. And I'll note that if your spouse works, then your spouse can also exclude that amount as well. So what do you need to do to qualify for this? Well, you need to fall into one of two categories. You either need to meet the physical presence test, which means that you are physically present inside a foreign country for 330 days in a 365-day period. So it doesn't have to be January 1st to December 31st. You can run that 365-day period, through any part of the year. But the key is to be inside a foreign country for 330 days. According to the IRS, a day starts at midnight. So we often hear people say, I was in the US for 35 days this year, so I should qualify. But being inside the US for 35 days doesn't mean that you're inside a foreign country for 330 days. Because there's some travel time that it depends on when you get there and things like that. So I always recommend people either diligently study the exact details or give yourself a little bit of room for error, just in case you're traveling on a day you're supposed to be inside a foreign country or something like that. Don't cut it too close, because if you end up having to pay tax on that $99,200, that could be a very expensive mistake for the cost of a couple extra hours, being inside the U.S. or traveling to or from. The second criteria on here is known as the bona fide residence test. And basically the way this one works is you have to be in a foreign country for a full calendar year before you can even be considered to apply for it. And then it's really just about living in that country full time with no immediate plans of returning to the United States. So if you're a contractor working overseas, it's assumed that at the end of your contract you will return to the United States. So you're not going to qualify as a bona fide resident if you're a contractor. This is more for people who are permanent residents of a foreign country. We lived in London for a long time. Our first son was born in London, and we were bona fide residents in London. We were working there, we were paying taxes there. Our life was in London, and we didn't have any plans to return to the United States at that time. So, the bona fide residence test is a little bit harder to qualify for, and you really need to be able to prove with your actions that you're living permanently in a foreign country. Does that make sense?
I'm sure, and I'm certain things like the kind of visa you have, or if like we had European Union Dutch passports, so that would all go into that bona fide residence factor.
Yeah, exactly. So if you've got a permanent residence status inside the foreign country, and you're working there, maybe you own a home there, you have a long-term lease on a house there, those are all things that are illustrating that your life is there and your life is not somewhere back in the United States.
Right, right. So anything else you want to say about that?
Just one thing to note about, or two things I'll note about the foreign earned income exclusion. The first one is if you're self-employed and your business is set up either as a sole proprietorship, meaning you don't have a business entity, or your business entity is set up in the United States, you might still have to pay self-employment tax, and that is applied before the foreign earned income exclusion kicks in. So, if you're self-employed and you're using the physical presence test to qualify for the foreign earned income exclusion, while you spend 2 years traveling the world, you're probably still going to owe the 15.3% self-employment tax back in the US. So, that's one thing people really need to know and understand.
Yeah. So just noting that that's important, particularly probably for expat partners who maybe are running their own businesses via internet, to pay attention to that, because this would, if I understand you correctly, this would apply to them.
Yeah, exactly. So if you've got an internet business or you're doing some part-time work while your spouse is employed full-time overseas, maybe you're doing work on Elance or one of these online work systems, you're going to need to report that income, and it's going to be self-employment income because you're not working for a foreign company, you're working for yourself, or you're working for a US company. So you can still exclude a big chunk of that earnings, but you do have the self-employment tax, which comes out first.
Right, right.
And the other thing I'll note is that with the foreign earned income exclusion, if you take it 1 year and then the next year you qualify for it, but you don't take it, then you can lose the option to use it for a period of 5 years. So it's just something to note, and that's very detail oriented, so if people have questions about that, they can let us know. But it's just something to know that when you choose to use it, make sure that it's the best option and that you wouldn't be better off with the foreign tax credit, which is Form 1116.
Right, okay, good. Thank you. Let's go on to the next question, which is, imagine that I don't qualify for the foreign earned income exclusion, and that could be at least for one of two reasons. One is you don't qualify for the residence tests, or your income is such that you don't qualify in one way or another. How can you reduce, how could I reduce US taxes?
Sure. Well, the form I just mentioned, Form 1116, which is the foreign tax credit, that's what you would use in this circumstance. So this form is usually used by individuals who are living in high tax foreign countries. So if you're living anywhere in Western Europe, you're probably using this. And basically what it is a dollar for dollar tax credit on taxes paid to your host country. So if you're living in the UK, let's say, and HMRC taxes you 40% on your income, assume your income's $100,000, you pay $40,000 to HMRC, you then have a tax credit on your US taxes for $40,000. So when you report your income on your US tax return, you say, I earned $100,000, and the IRS says, that's wonderful, you owe us, your combined tax rate will be 28%, so you owe us $28,000, and you say, no thank you, I've already paid. I paid HMRC $40,000, you want 28, so now I've built up $12,000 in tax credits, which you can either carry backwards 1 year or you can carry it forward up to 10 years to use against other future foreign income. And again, that's probably more detail than a lot of people need to know, but what you really need to know about this is that you would use the foreign tax credit if you live in a high tax foreign country. So if the tax rate's higher than the tax rate in the United States, you'd probably want to use the foreign tax credit.
Right. And the fundamental reason for that is that you shouldn't be taxed twice for the same income.
Yeah, exactly. Like the reason you would use it really is if you're already paying more to a foreign country than you would pay to the US, it's actually a benefit for you in some ways because you'll build up tax credits that you can use going forward to offset other foreign income against your US tax return.
Yeah, great, great.
And just very quickly, 4 criteria must be met in order to use this credit. The tax must be assessed on income. You must have a tax liability that has either been paid or incurred. The tax must be imposed on you as an individual. So if they're taxing your business or something like that, that doesn't count. It has to be imposed on you as an individual. and the tax must have originated legally in a foreign country. So, your friend in Kenya, if she gets pulled over by the cops and she jokingly calls, having to pay the police officer, $5 or whatever it is to get out of a speeding ticket or something like that, that's not actually a tax. It's not a legal tax. So that's not the kind of thing you could use the foreign tax credit to offset. It has to be a legal tax originating in a foreign country.
Right. Okay. Yeah. Thanks. Great. Here's one that I know I struggled with is how do you calculate the exact currency conversion for tax purposes? And this can make a big difference. I'm just thinking of the euro. A couple of years ago, it was, at $1.30, $1.40 for the euro, and now it's about 1-to-1. So it can have a huge difference in the amount of dollars that you pay. So how do you calculate that if you're looking back like at last year, or maybe even if you need to file for something 2 or 3 years ago, how do you figure out what the currency conversion is?
Well, the IRS is very helpful here in that they do not give you any official conversion rates.
Is that sarcastic?
Yeah, 100% sarcasm.
Okay. Just to be sure.
So, if you go to the US Department of Treasury website, they'll have some exchange rates on there, or you can go to websites like onda.com and you can get the historic currency rates off there. The important thing is that you use the rates consistently. So you can't use, on the same tax return, you can't use one rate from the Department of Treasury website and then another rate from onda.com because sometimes people will have slightly different rates, but you have to use the same source across the entire tax return. Now, for income that's received evenly throughout the tax year, generally it's easier to use an average currency exchange rate for the whole tax year. But if you've had a year where you've had some pretty major currency swings, the euro has dropped pretty dramatically against the dollar so far in 2015, you might actually be better using a monthly exchange rate in order to get the lowest US dollar figure on your tax return so that you have the lowest potential US tax burden. Now for single transactions such as the sale of a business or property that occurred on a single day, you can use the exchange rate for that day. And then if you need to make tax payments to the IRS, you must use the currency rate on the day the bank transfer or the payment was made, not when the money was taxable. So, if you received, let's say you're Boris Johnson, you sold your house in London, you have a huge tax bill from the IRS because he was born in the United States. It's the currency exchange rate he would use would be for the day he makes the bank transfer, not necessarily for the day he sold the property. And if you go on the IRS website, I believe there's a handful of companies that they recommend to get the currency data from. I know O&A is one of them, and I've never heard anybody complain about using them.
Yeah. Okay. Yeah, that's very important information because again, I had this situation where you look back a year or two and you think, what rate should I be using? And so it's very important to pay attention to that.
Yeah, especially like if you're a late filer, or something like that, where you need to go back 6 years for your foreign bank account reports. You really want to make sure that you're reporting all this stuff accurately and you have an easy way to get that information.
Yeah, because you're on their screen already by the fact that you're a late filer.
Yeah, exactly.
They're watching.
Exactly.
I mean, that's exactly the situation I was in, so I know all about it. Okay, let's go on to the next question. What are the FATCA reporting thresholds?
Sure. So just briefly again, the FATCA is the Foreign Account Tax Compliance Act. This is Form 8938. It's a part of your tax return, unlike the FBAR, which is a separate Treasury form. So the filing thresholds are different for somebody living overseas than somebody in the United States. So if you're living overseas and you're a single filer, it's $200,000 on the last day of the year or $300,000 at any time during the year. And then if you're married filing jointly, that doubles basically. It goes up to $400,000 on the last day of the year or $600,000 at any time during the year. Now, if you're living in the United States, that goes down pretty dramatically. So for a single filer, it's $50,000 on the last day of the year or $75,000 at any time during the year. And for somebody married filing jointly who's living in the United States, again, it doubles. So it's $100,000 on the last day of the year and $150,000 at any time during the year. That's especially important for people to understand if they've been living abroad for a while, they have some money or investments saved up overseas, and then they decide to return to the United States, whereas while they were living overseas, maybe they didn't need to file the FATCA forms. When they return to the United States, they may then need to file those forms.
And this may be a little too detailed, but by assets, you mean bank accounts, investments, properties minus the value of property minus mortgage, that kind of thing?
Yeah, exactly. So, you're going to have your regular bank accounts, you're going to have your stocks, bonds, investments. If you own property in your name, that does not need to be reported, but if you own a property in some sort of corporate structure, you would need to report that. So, it's a little bit different than the FBAR form, but largely very similar. It's all the different financial assets that you could own while overseas.
And I see we're already then into the next question, which was exactly that question: what assets need to be reported?
So yeah, as it says on here, so you have stocks or securities issued by a foreign corporation. That would include a privately held corporation. Savings deposits, checking accounts, brokerage accounts, interest in a foreign entity, so in a foreign company or LLC or anything like that. Any financial instrument or contract held for investment must be reported if it's issued by somebody who is not a U.S. person. This would include things like partnerships interests in foreign partnerships, interest in foreign retirement plans or deferred compensation plans, interest in foreign real estate or foreign issued insurance contracts. But again, your personal home doesn't need to be reported. It's just if you have, basically real estate investments, things like that, those would need to be reported. One question I hear a lot, people ask if gold bullion needs to be reported. And basically it depends on how you own it. So if you own the gold in your name, stored in your safe deposit box, which is held in your name, or stored in, under your mattress or wherever you would keep it, then you don't need to report it. But if you own gold bullion and it's held by somebody else, then you would need to be reporting those assets, which, it's a small distinction, but it's one worth noting, especially if you're somebody that likes to invest in gold.
All of you listeners who have gold, please take note. Okay, here's the question. I mean, this is exactly my situation. I think it was back in 2009 or so. I got this letter from the IRS. I hadn't filed for about 6 years because I just never got around to it, and I had moved, so they didn't have my address for a while, and so I wasn't getting their reminder letters. So it was just out of sight, out of mind. And all of a sudden, I get this letter. So then I had to file for the previous 6 years. Things are probably a little different now, but what do you do if you find out that you have not been compliant and you need to get compliant?
There's really two programs that the IRS has now for people who have not been compliant, and I'll start with the one that's on the bottom here, the Offshore Voluntary Disclosure Program. Basically, that program is for people who have been willfully hiding assets overseas. So, these are the people with the millions of dollars or, however much money hidden away in Swiss bank accounts. I guess technically money launderers and drug dealers and all these people would fall into this category as well if they're hiding their assets offshore. And basically the way this program works is in order to avoid criminal prosecution, you pay a penalty which I believe is 27.5% unless the IRS is already investigating the bank you're working with. They're investigating a number of banks in Switzerland, and if they are already investigating the bank you're working with, I believe the penalty is 50% of the account value of the assets you've been hiding overseas. And you'd need to go back, it's 6 or 8 years now for the Offshore Voluntary Disclosure Program. And we often recommend that if you fall into the camp where you need to use that program, then you should work directly with an attorney, and you can then hire a tax company like ours to do the tax work, but you have that all flow through the attorney because you want to maintain the attorney-client privilege in that circumstance.
Yeah, so, and the reason for that, of course, is you want to stay out of jail.
Exactly. So if for some reason they decide to deny your voluntary disclosure program and go after you with criminal charges, you want to make sure that everything that's been said is protected by the attorney-client privilege. Again, hopefully nobody listening to this falls into that category, but if you do, it's definitely worth speaking with an attorney about how you go about getting caught up.
So this is for all of you who have purposely hid your gold bullion.
Yeah, pretty much if you got a Swiss bank account, the IRS doesn't really like you that much, even if you happen to live in Switzerland and use your bank account to pay your rent and electric bill.
Yeah.
That's a totally different story. For most people who fall behind on their U.S. tax filing, which is actually very, very common, the best option to get caught up is what's known as the streamlined filing procedure. And the way this one works is you file 3 years of back tax returns and 6 years of back FBAR forms, and you have to certify that your lack of filing was non-willful. So, basically you say, I'm very sorry, I didn't know I had to file, or I forgot to file, and it all just got away from me. I won't let it happen again. And so, you file all this stuff, and the benefit of this program is that you won't get hit with any late filing penalties, and you won't get hit with any of the FBAR penalties. So that's pretty attractive. Like one of the big scary things about the FBAR is that the penalty starts at about $10,000 for failure to file. So, if you failed to file for a number of years, obviously that can add up. So you're much better off using something like the streamlined filing procedure to get yourself caught up.
Okay.
And those are the two main ways. There used to be what people would call the the quiet disclosure, which was before they had the streamlined filing procedure. People would just file a couple tax returns and a couple FBARs and keep their head down and hope nobody noticed. And that's not really a good option anymore because there is this streamlined filing procedure, and really that'll allow you to file with a lot more confidence that you're not going to get hit with any penalties.
Yeah, yeah. Thank you very much. All of that is very, very helpful. And again, if anyone is anything like me, a lot of this stuff just kind of goes over your head just because you're not a financial accountant tax type of person. And that's probably why you need to be in contact with somebody like Greenback just to help you work through the details and make sense out of all of the regulations and requirements that there are. Are there any other things you want to comment on, David?
Well, I'd just say to follow up on what you said, if people have questions about their specific circumstance, feel free to shoot us an email. The best way to get us is info@greenbacktaxservices.com. And also, it's worth having a look on our website. We've got, it's probably over 350 blog posts now, all outlining different areas of the tax code and how it impacts expats. And most of those have been written by CPAs or IRS enrolled agents. It's all very high quality information, and what we try and do is really break it down so that the average person can understand it. We try and get rid of as much of the jargon as possible and really just explain it in a way that normal people understand what we're trying to say.
Right.
Now, if anybody has any questions they want to ask now, they're welcome to type them right into the little chat box, or I believe we have a way if people are calling in via telephone, not via their computer, that they can press a button and ask us a question that way as well.
While you're waiting for that, a question came up in my mind. Imagine that someone is planning to become an expat in the next months or has just in the last year become an expat. What would be a couple things that he or she should do to kind of prepare or be ready to handle these kind of issues as efficiently and clearly as possible? Are there a couple things you would say about that?
It largely depends on where you're going and how long you plan on going for. So, if you're going on a one-year contract to a foreign country, you probably don't have to do quite as much prep work. But if you're planning on moving somewhere for an extended period of time, you'll really want to make sure that you've got all of your financial stuff back in the U.S. all tied up. There's a whole lot of different things I would recommend people look at, starting with make sure that the bank you're using in the U.S. Will allow you to operate the bank account from overseas. There are some instances of U.S. banks closing accounts of Americans living overseas because of the FATCA rules.
Mm-hmm.
I always recommend using a mail scanning service so that you can get your mail from the U.S. in a timely manner. And the way those work is you sign up with them. You have to give a authorization to the post office saying that they're allowed to receive and open your mail. And what they do is they scan the front cover of any envelope and send you an email saying, do you want us to open and scan this? And if you say yes, they'll scan all the contents, and then you'll be able to access a PDF of it, which it's really helpful, like not just for gathering your tax documents, but for making sure that your driver's license doesn't expire or anything like that. It just, for a long time, my wife and I had our mail going to our parents' houses, and you'd go home every 6 months and get it, and everything would be outdated by that time.
Yeah, sure.
Make sure that you keep pretty good records of any moving expenses or plane tickets you're buying. Keep track of all your travel dates because you'll probably want to use the physical presence test in the first year to qualify for some of those expat benefits, things like that. So really just make sure you're keeping good records, and make sure you have a way to get the information that's being sent to you in the United States while you're overseas.
Right. And I guess these things all also apply to someone who's 65 plus and is retiring somewhere in Costa Rica or in Portugal or someplace. The same.
Yeah, absolutely.
Not huge differences there.
Yeah. Even if you fall into the snowbird camp and you're going to be gone for 6 months at a time or something like that, the mail service thing is a great thing to do because you'll still receive all your utility bills and all that kind of information, so that you're not surprised to come home and have a whole stack of bills and angry creditors and all that kind of stuff. And one trick that we started doing a number of years ago is just make sure you have 2 separate bank accounts, even 2 different financial firms with 2 separate ATM cards, because depending on where you're going, that information can be compromised. I've had my ATM card compromised a number of times, and it takes a bit of time for the bank to send you a new card. So even when they're rushing it, depending on where you live, maybe that's 3 days, or maybe it's a week, or maybe it's 2 weeks. But if you're relying on that account to take cash out of, then not having access to it for a week or 2 weeks can be pretty miserable. So it's good to have a backup account where you have some money in the second account, and in case of emergency, you can use that ATM card.
Great tip.
Okay, I don't think we're getting a lot of questions coming in, so I think we can probably wrap it up here. Again, if people have questions that are too personal to ask in this forum, then definitely feel free to shoot us an email. Just put in the title of the email webinar, and we'll prioritize the response to those.
Great.
Norman, thank you very much. It was great chatting with you again, and hopefully we can do this again next year, and just spread the word and make sure people are informed about what they need to do.
Yeah. No, and thank you, David. I really appreciate. Again, I work with expats. A lot of them are U.S. and it's just so helpful to have this kind of information so that you don't get surprised by again, the IRS or other angry creditors. It just gives so much peace of mind to have your things ordered, and then of course to have somebody like Greenback there helping you make sure that things are done in the way that will give you the least problem, and of course the least cost and the least chance of ending up in jail.